The Strait of Hormuz is reopening. Global shipping operators are already repositioning vessels, flowing back toward the Gulf to resume standard transit routes. The direct catalyst for this movement is the newly signed 60-day interim deal between the United States and Iran. This memorandum of understanding immediately deflates the severe geopolitical risk premium that had been priced into energy markets over the last several months. This chart shows Brent crude's trajectory. You can see the steep conflict premium build, followed by an immediate 40% drop. The price plummeted, breaking straight through the critical $79 per barrel threshold. When crude oil prices gap down this aggressively, it shatters the momentum that has been driving the consensus market narrative. For quarters, institutional positioning leaned heavily into a stagflationary environment. That specific regime, built on acute energy fear and constrained supply lines, is dead. We are now looking at a massive cross-asset repricing event as capital is forced to adjust to the new reality. To understand how aggressive this repricing will be, we have to isolate the components of that stagflation trade. It relied on three pillars: rising energy costs, tariff pass-throughs, and sticky services prices, all running headlong into restrictive central banks. The conflict did not create those inflationary pressures. Rather, it acted as an extreme macro amplifier, multiplying the effect of tariffs and services already straining the system. The 60-day Memorandum of Understanding surgically extracts that energy amplifier. It leaves the foundational inflation problem exposed, but it strips away the immediate accelerant. Neutralizing the energy component alters the macro regime. Even if the core inflation problem remains unsolved, the market positioning required to navigate it has shifted entirely. The drop in crude oil prices does not stay isolated in the futures market. Instead, it feeds into broader input costs across the real economy faster than almost any other macro channel. Consumers feel this first. The most immediate downstream effect hits the fuel pump, driving plunging prices for both gasoline and diesel. A secondary wave of relief hits industrial producers. As crude derivatives fall, we see corresponding drops in critical manufacturing inputs, specifically fertilizer and LNG. High energy prices function as a regressive tax. When that tax is cut, we see a simultaneous boost to household real disposable income and an expansion in corporate profit margins. This transmission hits market pricing directly in this Bloomberg chart of inflation break-evens. On the right, market inflation expectations sharply decline. Notice the convergence on the far right edge. The 2-year break-even and 5-year forward inflation swaps are collapsing toward 2.34. This rapid disinflationary impulse provides immediate breathing room for duration-sensitive assets. Investors holding defensive, short-duration portfolios are now scrambling to reposition. This geopolitical relief does not impact the globe evenly. Europe benefits far more directly and aggressively from the energy drop than the United States. The mechanics are straightforward. Europe is a net energy importer. Plunging gas prices instantly reduce the continent's import bill, directly supporting Eurozone fiscal balances and corporate margins. For the Italian sovereign debt market, this transmission channel runs straight through the European Central Bank. Lower energy inflation reduces the hawkish pressure on the ECB Governing Council. That policy relief directly supports the tightening of Italian BTP over German Bund spreads, provided the broader risk appetite in the market holds. This regional dynamic drives a specific cross-asset rotation requirement across global portfolios. Capital is migrating into sectors penalized by the energy shock. The primary beneficiaries are cyclicals, consumer discretionary, industrials, small caps, and long-duration growth. Conversely, oil and energy equities lose the narrative advantage they carried during the disruption, and pure defensives are surrendering their war premium. The old positioning structure is obsolete. Being long energy, short duration, and heavily weighted in defensive credit now looks dated rather than prudent. Cautionary: we need to clarify a crucial risk factor. The underlying structural inflation problem is not solved. This chart shows the split reality. We are witnessing a steep drop in headline inflation driven entirely by energy. But core categories, services, wages, rents, insurance, and healthcare remain rigidly flat and elevated. Companies that successfully push through price increases during the energy shock have zero incentive to reverse those hikes just because crude has fallen. This setup shares similarities with the quick reversal of the 1990 Gulf War, but with one major difference. Today's core inflation problem existed in wages and tariffs long before the geopolitical strikes began. The Federal Reserve, the ECB, and the Bank of England recognize this. They will not pivot their broader policy path based on a single geopolitical event, when the inflation problem has broadened into categories that move slowly. The macro environment is currently trapped in a bifurcated reality. The acute energy crisis is over, but the structural inflation baseline remains highly elevated. There are specific physical tripwires that could instantly invalidate this duration rotation trade. First, the U.S. Iran deal is fragile. It is a 60-day interim window, not a permanent treaty, and the diplomatic framework could collapse. Underlying physical shipping risks persist. Tight capacity and elevated tanker rates remain structural threats to the supply chain. The critical price threshold to monitor is Brent crude. If we see a rebound pushing back above the $85 to $90 range, the stagflation unwind will prove premature. Assuming the deal holds, the final strategic posture shifts. We are moving from a state of broad stagflation panic towards selective, targeted risk appetite. Institutional portfolios must accept that we are not entering a clean disinflationary boom. Internal equity rotation, rather than broad index direction, will dictate performance in the months ahead.